why I'm adding the Vanguard Dividend Growth Fund to my portfolio. And look, I'm not saying you should or not, but you know how I feel about VTV, the Vanguard Large Cap Index, Value Index, I should say. And I thought there'd be a lot of redundancy in there, and I'm sure there is, but I'm telling you, I was working with a guy today, and he's got the G fund for his TSP, and he wants to put his non-TSP, he sold a house, he wants to put the proceeds in aggressive funds, and we just got to talking VTV, VDIGX, and look, we both kind of came to the conclusion, go half and half, and that's what I'm doing too. So let's dive into this. The fact that Vanguard Dividend Growth Fund is reopened is that's a big deal, and it's because of you guys that you made me aware of this fund, and I love it. I'll share with you why here in just a second. All right, so we're going to compare the Vanguard Value versus the Dividend Growth Fund. So here's the Value Fund. I got an SEC yield of 2.81. Dividend Growth Fund's got an SEC yield of 1.81, which is actually a little bit on the low side. But Dividend Growth Fund means there's more growing dividends, not already established dividends, if that makes sense. So that's why I like the Vanguard Value Fund, because the dividend's quite high. Expense ratio is 4 basis points in Vanguard. That's why I'm saying all these people say, oh, Fidelities are free, or Schwab, whoever it is free. Man, you're talking 4 basis points. What's that, 40 cents per $1,000? It's not a big deal. This fund has been around, I don't know the inception on this guy, but the other fund's been around since 1992. Does it say inception on here? I'm sure it does someplace. Let's see here. Oh, here we go. Fund analysis, portfolio. I don't see inception. Do you all see inception on here? Anyways, got 50 billion in assets, and let's see the dividend growth. Where's the assets on this guy here? Looks like a couple different charts. Where's the asset? I don't see the assets. See any assets on here? I don't see 38 billion in assets. Okay, so I'm sure they're going to close this right back up once it's above 50 billion. I don't know that, but I imagine. A Russell 1000 is his total return is his benchmark. So that's growth and value. The Russell 1000, where the VTV, let's see what they have for a benchmark here, is going to be, I'm sure it's just a large cap value. And this is weird. It's two different things here, right? It's hard to follow. Anyway, I imagine it's going to be the large cap value. So let's go over here to portfolio. This is VTV, and I like this too, don't get me wrong. So we're going to look at VTV, 99% U.S. stocks, all right, large value ETF, yeah, Russell 1000 value, all right. So this is going to be the Russell 1000 as the benchmark. As you can see, it's geared towards the top, the large cap of value side of the blend. So I love it. I love value stocks. I love the fact it has high yield for sure. The Russell 1000 value I love. But remember, to be on the value side means you have to have lower than average PE ratios, lower than average price to book ratios, and higher dividend yields for sure. So some of these funds on the Dividend Growth Fund, we'll go to portfolio here. Some of the stocks in the Dividend Growth Fund won't fall for that because they're going to have higher PE ratios. In fact, you see they're a little bit geared towards the growth side, but dividend appreciators, which means they're growing their dividends quicker than other funds that are out there. A lot of times in value, you get funds that are more established, stocks that are more established, utilities and whatnot. So I like that. So you have immediate diversification, but with a dividend mindset, which I like. They do have 10% non-U.S. stocks, and that's not bad, but again, full stocks. But I want to show you something else here. I don't care about this. I literally could care less about sustainability. I don't. It's freaking stupid. I don't care about the wide moat cover. That's whatever that means. Don't care. Look how much. Look at this. How much they put into fossil fuel involvement. It gets a low carbon check. Yay! Don't care. In fact, if anything, I'd rather have a high carbon thing. But whatever, because you're gonna need fossil fuels for many years to come. But be it as it may, here are top 10 holdings. Anyway, so you can see the top 10. But the turnover is 23%. I'm going to do a video on active share tomorrow. That's a big deal in my opinion. The turnover is 23%, that means they trade a quarter of their portfolio every year. But look at this. They only got 41 stocks. Equity holdings 41. That's nuts. I mean, that's not a big portfolio, my friends. That's not very many stocks, which means it's very, very going to be a lot of concentration, and I like that. I mean, if you want to beat the market, you have to have a concentrated portfolio. How many stocks does the index have? Probably imagine 300. Yeah, 350. So they got 350. So let's see here. Any of these guys? Did I see? Top. I think Microsoft. Johnson Johnson. I saw that. I think Microsoft was in here too, right? No, all right. So just Johnson Johnson, the top 10. That's it. So just a little bit of redundancy there, not much. They got one bond. That's it, and they only have 8% turnover in VTV. All right. So percent of assets in the top 10, 23% of assets in the top 10, which means everything else is 75% on the rest of the portfolio. I imagine this got to be pretty high here. Percent of assets in the top 10 is a third of the portfolios in these 10 stocks right there, which again, that doesn't bother me. It doesn't. You want concentration, I'm telling you. And you can see here the other holdings that they have. I'm sure there's going to be some duplicates in there for sure. Marsh McLennan, that's kind of funny. It's an old insurance company. All right. But I want to show you something else. So let's go back here. I want to show you performance. They're going to close this once it hits 50. Look, I don't know that. I can just imagine the value index, because it's passive, they don't care. But a large growth, a large mutual fund in terms of total market capitalization, they can't have just unencumbered assets coming in. They're going to close this sucker out at some point. So I don't get commissions for this. Don't buy it because old Josh. But let's see. Yeah, they only give. All right. So basically, I want to look at performance. They give 10. All right, trail right here. So we got 15-year performance, 10%, which, yeah. So what are they saying since inception? What is inception date though? I don't see any inception date. Do you all see an inception date here? I don't see that. But I know it's in 1992. So yeah, 92 or 94. Now what is over 25 years. But 15 years, 10.07%. That's pretty good. They've beaten their category by almost 200 basis points. They've beaten the index by almost 100 basis points. 3, 7, 5, 5, consistent in the top 10 of their peers. It's nuts, man. Just a freaking great fund. But past performance doesn't mean anything. Yeah, I get it. But one of the reasons past performance does mean something is because the fees are so doggone low. That's all there is to it. All right, so let's take a look at value, the index. We'll go to performance here. And let's see what this guy is. I imagine a 4-star, yeah, index are always going to have a hard time being 5-star. And here, 15 years, 8.27. So there's a significant reduction in performance over 15 years. All right, so we got, look at this. We got 10.07 over 15. Here's 8.27. So remember, 10% means this sucker doubled twice in this 15-year time. This did not. This doubled about once and a half, because the rule of 72 is if you get a 10% rate of return, you're doubling your money every 7 years. So the VTV got smoked by the VDIGX, VDIGX, that's for sure. But look, even this is still 3, 5, 10, 20. It's still in the top 20, essentially, going back historically. I'm a big fan of that. Let's watch the last 5 years. 5 years, 10% total return. All right, and then 12% over 10 years total return. Here's 13.35. So you can see there's been a tilt in favor of the growth stocks for sure, which is another reason why I like value, because the growth stocks have been smoking value for the last 10 years. But I want to show you taxes. I think they show taxes on this. Price portfolio. Where are the taxes? Just look at this with a guy today. Maybe I was looking at Vanguard. Yeah, maybe it was fund analysis. So let's just see if that's on here. They used to show they changed their website quite a bit. I wish they did not do that, but they want more and more people to pay for it. Let's go to risk. I don't think that was it. Under risk. See anything on taxes? Yeah, all that stuff. All right, anyway, if you go to Vanguard's web, I'm not going to do that. If you go to Vanguard's website, though, you'll see what the taxes are. Just not much of a turnover. I think it's like 5% in the value fund, and it was like 23% in the growth, and the not growth, dividend growth fund. Both are pretty low turnover. But let me pause for a second, because I want to show you something I found very interesting. Hold on just a second. So one thing I like to look at is, what did the fund do in 2008? I do like looking at that. So remember, one is a value stock fund, the VTV, and one's a dividend growth stock fund, with a leaning towards growth. All right. So remember, Wellington actually was down 22.3% in 2008. So let's look at VTV first. Remember, the S&P 500 in 2008 was down 37. So Wellington was down 22. The S&P 500 was down 37. What did VTV do in 2008? It was down 36, 35.91. Next year it came back, relatively strong at 19.72. What did VDIGS do? Down 25.7. That 25.5. So this was down just a little bit more than Wellington was. That's pretty fascinating to me. Yeah, 92 is when it started off. So 94 is down 8. When did the VTV start off? Yeah, 2004. Okay. So we don't really have much of down. We don't know what VTV would have done during the 2001 and 2 calamity. But watch this. Remember 2000, 2001, and 2. What did the S&P 500 do? The S&P 500 was down 9 in 2000. It was down 11 to 12% in 2001. It was down 22% in 2002. Watch this. It was up 18.7% in 2000. Down 19%, so it got smoked relative to the S&P 500 in 2001, and it was roughly with the S&P 500 in 2002. But in 2000, it was up 18%, while the S&P 500 was down 9. And yet in 2008, it was down 25, where the S&P 500 was down 37. I find that to be very, very attractive. Actually, I'm a big that's a big deal to me. 94, 99, why were they down? Because the Feds were raising. So anything that was income heavy, bonds were down, and obviously a dividend growing would be down as the Feds were raising interest rates. So, I mean, I just tell you, man, I'm a big fan. So I meant to buy it today. I just got too tied up, but I'm going to buy the sucker tomorrow. Again, do not buy on my reg. I don't know your situation. I don't know what you've got going on. I'm just saying, you put these two together, that's a pretty good stock portfolio for me, without question. A little bit of international exposure, not much, but I like it, so that's where I'm going. All right, we'll see you next time.